What's up, everybody? Welcome to Heresy Financial. This is the channel where we discuss financial topics in a way that is considered heresy to the financial establishment. Today, we are going to be discussing commission-free trading on the back of Charles Schwab announcing they have completely eliminated commissions. Let's dive in. All right, guys, if you haven't seen it already, today Charles Schwab announced that they are eliminating trading commissions. Previously, they were $4.95 for stocks and most ETFs, although just like Fidelity and Vanguard, they did have a few hundred ETFs that were already commission-free to trade. Now, this is just following in the latest trend in the industry to become the leader in cheap pricing. It has been kind of a race to zero between all of the major online brokerage companies out there. E-Trade, TD Ameritrade, Fidelity, Schwab, Vanguard, they've all kind of been in this race to zero over the past 5 or 6 years. Just 6 years ago, I think Schwab's trading commissions were $9.95. TD Ameritrade was up around $12. Now, obviously, Schwab is zero. Fidelity, at least right now, is still at $4.95, although I would not be surprised if they quickly follow up with matching and announcing the same thing, because Schwab and Fidelity have kind of been in lockstep with each other over the last few years, matching each other's pricing. So this is what we're seeing right now. Today, we're kind of going to dive into if that's a good thing, what that means for investors, and what to watch out for, because as you know, with anything in life, free is not always actually free, and usually there are hidden costs that allow a company to offer something at a free price. So let's dive into how Schwab makes money. Full disclosure, if you weren't aware from some of my past content, I did used to work at Charles Schwab. I played a part in various different roles during my time there, so I have a pretty good understanding of how the company works. Number one, over the past few years, they have continued to make a transition from how they make money. About 10, 15 years ago, it was primarily from trading commissions, just like most online trading companies. Recently, they've made a move to where they make most of their money from interest on cash reserves and from wealth management fees. This move to how they actually make money led them to have to cut some of their workforce. If you noticed them in the news, about a month ago, they laid off about 3% of their workforce. Now, that might have been in anticipation of this cut in commissions, knowing that they were going to have a reduction in revenue, just kind of bracing for impact there. But it could just be them knowing that they need to make some changes to stay competitive, because more and more companies are getting cheaper and cheaper. Companies like Robinhood and Webull have been offering commission-free trading for a while. There are other online trading companies as well that do this. So the question is, why isn't everybody at zero? Well, it's because of the way that these companies make money. Some of these companies make money in a very straightforward fashion. Companies that have always charged a commission, usually they make their money from trading from just those commissions. Companies like Robinhood, though, make their money in a little bit more of a non-transparent or sneaky way. So we're going to get a little bit technical here, so hang in here with me. When you place a trade, you're going to look at the price of a stock. You're going to look at, let's say, Amazon, and you're going to say, hey, Amazon is, let's say, $1,740. I don't know if that's the exact price, but it's somewhere around there. That's not actually representative of how the market works, though. There's never just one price for something. When you go to place a trade, there are hundreds, thousands, or millions of other people who have prices that they've set, and they've said, hey, if the price gets to this level, I'm willing to buy shares, or if the price gets to this level, I'm willing to sell shares. So those are called the bid and the ask. Now, the person or people who are willing to sell their shares at the best price possible, the lowest price point, that's called the national best offer or the best ask. And then there's the hundreds, thousands, or millions of people who are willing to buy that stock at lower and lower prices. The person who's willing to buy it at the highest price, though, that's the national best bid. And so when you look at the price of a stock, you're normally, when it lists one price, you're normally just looking at the last trade. What was the last price at which those two numbers matched up and a trade actually happened? Money got swapped for shares. But and in between the times when there's an actually transaction executed, there's always a difference between what somebody is willing to buy the stock at and what somebody is willing to sell the stock at. That's the national best bid and offer. That's the spread. Let's say somebody right now, the market's closed, but let's say the person who's willing to buy Amazon at the best price says, I'm willing to buy it at $1,739 per share. The person who's saying, I want to sell it at the best price that's out there right now is willing to sell it at $1,741 per share. If you come in to buy Amazon, you can either just sit on the market with an open order, just like everybody else, or you can come up and you can meet the seller. Now, let's say you try and meet them halfway in between. Let's say, hey, I'm willing to split the difference and I want to buy it for $17.40. Well, then the seller might see that and they might say, hey, you know what? That's good, I'll meet you there. And they might lower their price. Now you matched up, the transaction executes, and now the next people in line come in to trade. Now, realistically, this happens millions of times per day for every stock. And the vast majority of these trades are done by computers. So when you put in an order to buy a stock or sell a stock or an ETF, usually you're just doing a market order. Now, a market order means I'm willing to buy or sell this stock at whatever the next price is. And so if you're buying the stock, you're going to come in and you're just automatically going to match the best seller's price. If you're selling the stock, you're just automatically going to come in and match the best buyer's price. That's a market order. You're just saying, I don't care about the price. I don't want to sit on the sidelines and wait for the market to move in my direction. I just want to get executed immediately at the best price available. The people who are out there executing these orders that are creating the bid and the ask, 9 times out of 10, they're market makers. These are companies that have the task of maintaining liquidity in a market on a stock. They're the ones that are saying, we're always going to have orders available on a given stock or ETF. Now, there might not be a lot of volume in all stocks. There is a lot of volume in the bigger stocks. There's not a lot of volume in the smaller stocks. And so because of that, the market makers, in order to be compensated for always having orders available, prices set at which they would buy or sell that stock, in order to be compensated for that, what they're going to do is have a big spread in between the bid and the ask. And that way, if they have people come in and wanting to buy and sell that stock back and forth to them, you want to buy it and then this other person wants to sell it, I'm going to match up the orders, but I'm going to take the spread. I'm going to take the difference. That's how I'm going to make money and compensate myself as a market maker in this stock, because if something goes wrong, I'm the one that's maybe stuck holding or shorting the shares because I've promised to maintain a market in this stock. I've promised to make sure there's somebody at least on one side or the other buying and selling this stock. That's the role of the market maker. That's a legal job that different stocks and ETFs have. So how does this impact your trading? Well, when you go and submit a market order, like I said, you're going to get executed at the next available price. If you're buying, you're going to match the person who's selling, normally a market maker. If you're selling, normally you're going to match the person who's buying, the market maker on that side. When you trade somewhere like Fidelity or TD Ameritrade or E-Trade or Fidelity or historically Schwab, some of these larger companies, they have a lot of orders that run through them. And so when a market maker who's making the market in Amazon is negotiating with Charles Schwab or Fidelity or TD Ameritrade, they're going to say, hey, we want a lot of your orders. We want you to send us, instead of the other market maker who's also operating on Amazon, we want you to send us the orders instead of them. And in return for that, we'll give you some of the spread. On every trade, let's say they make 1 cent or a half a cent. It's usually it's a small fraction. It's just millions of times per day. And so they're saying, hey, if you send us a certain amount of orders, we'll send you a kickback of the spread that we get. And so companies like Schwab and Fidelity and TD Ameritrade say, that's fantastic. That's a win-win situation because now we can take that improvement on the price that they would have gotten if they would have just matched up, you're going to give us some of that because you're the market maker creating that spread. And if you're taking some of that spread and giving it back to us, well, we're going to give that back to our client in the form of an order improvement. So normally if you're trading, you would have gotten 1741 for it. You would have paid 1741 for it if you just hit market order. But trading at one of these big companies, they might give you some of that kickback, and now you get filled at 1740 instead of 1741. Now, this is called order execution quality, and every company is required to disclose the raw data and the statistics on their order execution quality. These are called the 605 and the 606 report. You can Google it. You can find these reports that are legally required to be disclosed by every one of these companies. The companies that do it well and they give you as the client a big kickback, they're going to put up this report in a very easy to read format. Some companies like Interactive Brokers and TradeStation and Robinhood, the data is there, but it's hard to interpret, and usually it's something similar to just an Excel spreadsheet with just millions of lines of data that you'd have to kind of compile and interpret yourself. And they do it that way because they don't really want people to know that they're offering no improvement on your orders. Now, in addition to the price improvement that you might get at a larger company that actually charges you a commission, they're probably going to have a better speed of execution as well. And so when you hit buy or sell, you'll see your order go through really quickly. Whereas if you trade somewhere like Webull or TradeStation or Robinhood, when you hit trade, it might take a couple of seconds for your order to go through. And so these companies that are the smaller companies that offer free trading, what they're doing is they're pocketing all the difference. They're not giving you any of that. Now, that's perfectly fine because you're only legally entitled to receive the price of the stock that's the national best bid or ask when your order hits the exchange. And so they're not actually doing anything wrong because you're getting filled on the next best price once your order is presented. And that's the requirement. But if you're trading with trade sizes that are more than a couple of $1,000s a piece, you're going to be better served trading somewhere that charges a commission up front but gives you a kickback, because sometimes these kickbacks on average they can be $7 to $15 per trade. So your order, yeah, you might get charged $5, but you got a better fill that netted you an extra $15. Well, now that's a $10 difference compared to if you would have put a trade in somewhere like Robinhood that doesn't give you that kickback. Yes, it's free, but you got a worse fill than you would have. And so if you're trading with larger trades, usually it's going to net you better to trade somewhere that charges a commission, but also gives you a better fill. Now, that's the upfront way that they'll make money, but some of these companies like Robinhood and Webull and TradeStation and Interactive Brokers, they will also sell market data, your order data, to high-frequency traders. Robinhood is most notorious for this. What they'll do is they'll sell your data, and when your order goes in, that's one of the reasons why your order takes a little bit longer to get filled. Your order will be front run by high frequency traders. And so, especially if it's a large order and it's going to move the market just a tad bit, a fraction of a cent, they're going to have orders that are waiting in front and behind of yours that will take advantage of the tiny movement that your order might go through at. And Robinhood may also even lump certain trades together in order to make those trades larger, which is another reason why yours may take a little bit longer to get filled. So, what does all this mean? Well, number one, Charles Schwab may have to start resorting to some of these sneaky tactics to make money now that they're not charging a commission up front. Number two, it means that you just need to do your homework and not trust that free means free, because at a lot of these places, it actually does not. And that's one of my biggest gripes with people like Stephan. They're very, very experienced with making money in things like real estate, but the financial advice that they give for things like stock investing is cookie cutter advice that's no different than something you'd find on the advertising page for Charles Schwab or TD Ameritrade or Robinhood themselves, or even Acorns or a company like that. He's not giving you any information that you can't get from just Googling the company and looking at their advertised pricing. He doesn't understand some of the market mechanics that go into how these companies make money. And for somebody who's trading with over a few $1,000s per trade, doesn't really make sense to go somewhere that's free because you're getting screwed in the order execution. So now that companies are in this race to zero, and Schwab being one of the first big companies to kind of take the leap, you might see some more of these sneaky tactics being employed behind the scenes from the larger companies, which that's not a win for investors. That's actually a net loss. Now, TD Ameritrade and E-Trade today plummeted in their stock price because of this announcement by Schwab. And it's because TD Ameritrade and E-Trade, they make a lot of their money from trading commissions. And so TD Ameritrade was down 25% today. E-Trade was down 17%. They just got clobbered. And even Schwab's stock was down 10% today. And that's because they're giving up a lot of revenue now that the race to zero has started to come to a close. Again, it's not necessarily a win for investors, and I also don't think it's necessarily a win for financial companies, because while they might have to resort to using some more sneaky tactics to make money on the back end, they're also not going to be making as much money just in total. And so their profit margins are becoming smaller and smaller and smaller. And as companies make the transition from making money on trading commissions and fees to doing things that are free and just hoping that they get a lot of money and charge a little bit on it, their profit margins become more and more razor thin. That means they're more susceptible to a shock in the market, which kind of brings us full circle to why this is kind of dangerous, and you need to keep your eyes open, because as the system starts to roll over, starts to collapse, you start to see these shocks come in. We've talked about what's happening in the repo market. You see global tensions on the rise as Saudi Arabia has had 3 or 4 attacks now by the Houthis that they have no idea how to prevent and how to defend themselves against. You see things happening in Hong Kong with all the civil unrest and the protests happening in Hong Kong right now, with China on their week holiday right now doing their military parades, showing off their new military strength, their missiles that they just came out with. You have a lot of global tensions rising right now. And as you have shocks in the system, companies without a big profit margin go under. If you don't have a big profit margin, you don't have a big pillow to rely on. Profit isn't evil, it's just the oxygen that companies need to survive. That's all it is. It's just it's oxygen for companies. It allows them to survive, because if you have a big profit margin, well, then you have a buffer zone to be able to survive when things get tough. But these companies, especially like Robinhood, that might have been surviving just on investor money, hoping that they get a big enough market share so they can then put their competitors out of business and then start charging money, that's going to start going away, especially as the IPO bubble starts to pop and venture capitalists and big investors start to realize, hey, these things aren't working. Well, now some of these companies that are free and charging cheaper than the market would be able to supply, they're relying on this cheap money from investors and from cheap products. Well, as that starts to dry up, they're going to have to raise their prices, and then we'll have to see whether they actually have a business model that will work. Things like Uber, things like Lyft, and companies like, the big famous WeWork that's falling apart right now. They stopped their IPO process. As this investor money dries up and companies are no longer able to survive on this, well, the only way to do business long-term fundamentally is to actually have a profit. Shocker, right? So as these financial companies move more and more towards thinner and thinner profit margins, they're going to be more susceptible to failure. And so that's something to keep an eye on. Companies that have very small profit margins may not be a smart place to have your money, because if they go under, they will have to be absorbed by SIPC and get taken over by another firm. And if we have a big enough shock in the system, who knows what might happen to investors' money. So stay aware, do your research, learn, stay financially educated, and I hope this helps. Please leave any questions in the comments section below if anything that I said today was unclear. I know we got a little bit technical into how these companies make their money. So let me know in the comments below if you have any questions. Thank you for watching. You guys have a great day. Thank you so much for watching. I really hope you enjoyed the content. I try and put out as much content as I can, especially whenever there is something new happening in the market. Please like and subscribe. And if you want more, if you need a step-by-step plan in order to prepare for the coming financial crash, I did write a book. It is on Amazon. You can buy the Kindle version or the paperback. It's called Financial Heresy. You can also find it on my website at heresy.financial, but it's easiest if you just go to Amazon. You can again get the Kindle or the paperback. It's called Financial Heresy. Thank you so much again for watching. Please like and subscribe and share. You guys have a great day.